think I know many of you from looking at the participant list. So I'm Jim Allen. I'm the Director of Financial Planning and a firm principal at Anchor Bay Capital. So it's my job to provide all the financial planning and tax prep and planning services to our clients. I'm a certified financial planner. I'm also an enrolled agent. So I'm admitted to practice before the IRS on virtually any tax matter. I can represent you in front of the IRS. With me today is Blake Pinion. He's one of our associate advisors, and you may not know Blake. He joined us in December of last year. So a little background on Blake. Blake came to us from Fidelity Investments, where he was an advisor there. And prior to that, he worked at a couple other investment advisory firms. He has a degree in financial planning from Cal State San Diego. And he has recently passed his certified financial planner exam, and we're just a couple of months away from him fulfilling all of the experience requirements, and he'll be a certified financial planner. Blake's also a California registered tax preparer, so he's a licensed tax preparer, and Blake will be assisting me with preparing our client returns. So we'll split time talking about various topics this evening. So that's your presenters for this evening. Let's see if I can work. So what are we going to talk about? We're going to talk about the common tax mistakes that we see. That most clients or prospects that come in, some of the things that we see that are pretty common. And we're going to talk about strategies to kind of minimize or eliminate those mistakes. And so the primary ones we're going to talk about: tax location, tax diversification, tax loss harvesting. We'll talk about some charitable strategies, things like that. And then we'll talk about what's new for 2021, and then also kind of give you a brief glimpse of the Biden tax plan and what kind of the outlook is for any changes that are coming up in the immediate future. And again, that's all crystal ball stuff, because we don't know what'll happen at this point. So one of our main mottos at Anchor Bay is it's not what you make that counts, it's what you keep. And so one of the reasons we focus so heavily on tax planning is that we feel we can, earn our fee and save our clients just as much money by doing proper tax planning as we can by, trying to get them the biggest and best investment portfolio. We certainly pride ourselves on our investment strategies as well, and we have a very robust investment team. But it doesn't really matter whether we get you an extra 0.5% of return or we save you that same 0.5% through some smart tax planning. Either way, it's more money in your pocket, and that's really what it all boils down to. So, if you've attended one of our seminars in the past, or Social Security seminar, or one of our tax seminars, you know I typically ask this question. And so we won't have anybody raise their hands this time, but think about how many of you think taxes are going to go up now. We've just had a new president elected. We have changes to Congress. So what do you think? Taxes going up? How many of you think taxes are going to stay the same? Or how many of you think taxes are going to go down now? My guess is as good as any of yours. The only thing that I know, and I've been doing this for over 35 years now, is that tax rates change all the time. In fact, on average, since the start of the Internal Revenue Code, they change about every 4 to 4.5 years. So what does that mean? If you're going to be in retirement for 25 or 30 years, you're going to see another 6 to 7 tax law changes. And so a lot of the advice you've probably been given through the years is, you hit retirement, you're going to be in a lower tax bracket, and so you're going to pay less in tax. Not necessarily true. The rates change constantly. And I'll just give you an example. I just wrote a blog piece for our website this week on flexibility. You may want to go take a look at it. It actually refers to our old childhood friend Gumby. But someone who retired in 1990 was pretty much at the bottom of our tax rates, 28%. Well, 3 years later in 93, that same person is now at a 39.6% tax bracket. So their tax rates didn't go down in retirement. They went up by a couple percent almost. And so kind of the moral of the story is that we know they're going to change all the time, which means we have to have flexibility in our planning to adjust as tax rates change. Just to kind of give you a little perspective on this, this is 1950 to 1986, so, a 35 some odd year period. And you can see what the top brackets were. I mean, they were as high as 92%, and they typically hovered in the 70s for a big chunk of that. And then, we had President Reagan come in, and we had, the Tax Act of 86, et cetera. And so then you can see tax brackets have dropped dramatically since then. Like I said, they've been as low as 28%, 88 to 90. They were creeping back up. They went as high as 39.6 until we just had the last major tax act, the Tax Cut and Jobs Act, which now the rate's around 37%. So, if you're looking at this from a long-term historical perspective, rates have been as high as 92 and as low as 28 and anywhere in between. And that's kind of what we've got to assume, over a 30 or so year retirement, that we're going to have fluctuations in rates. And that's why proper tax planning is so critical to your success in retirement. So let me just kind of talk about some of the recent changes. We've actually, in the last 4 years, we've had 4 tax law changes. The biggie was the Tax Cut and Job Act in 2017. That's the one that was enacted under President Trump, where we had those tax rates change. They dropped from 39.6 to 37 for the top rates. Huge change in corporate rates, and that did stimulate the economy. And then there were changes in the standard deduction and itemized deductions, and that was a mixed bag. For some of you, when I've done your tax returns, it helped you because the standard deduction was increased, and so you were able to actually take a larger deduction. Others, because of some of the things that were in there, like the cap on state and local taxes, your itemized deductions went down or were eliminated altogether, and you saw an increase in taxes. So while it helped corporate rates for sure, it didn't necessarily help everybody who was a taxpayer. In fact, in California, because of the $10,000 cap on state and local taxes, it hurt a lot of property owners. And then in 2019, we had the Secure Act, which is related primarily to retirement plan and tax changes. And the biggie there was the change for required minimum distributions. So before it was 70.5, where you had to start taking the money out of your 401k or your IRA. That got bumped up to 72. And so now, unless you've already started at 72, you have to start taking the money out of your retirement plan. One of the things that has been floated just in the last couple of weeks has been raising that again to age 75. Because, when they came out with 70.5, life expectancy wasn't much longer than that. And now life expectancy is well into the late 80s or early 90s. And people are working longer. And so they're proposing changing that to 75. We'll see. The other thing that came out of the Secure Act was the elimination of what we call the stretch IRA. Some of you may have an IRA you inherited, and the kind of the planning there was, let's say you were 50 years old and your parents passed away and you inherited their IRAs. You could take that out over your life expectancy. So a 50-year-old might have a 30-year life expectancy, and so you could spread that out over a very long period of time and continue to defer taxes. Well, with the new rule, now you're forced to take it out over no more than 10 years. So they've accelerated the distributions from those retirement plans. That was kind of an offset for any of the other tax benefits they gave. So if you inherit an IRA going forward, the maximum you can defer it is 10 years. So you'll be forced to take it out within that 10-year period. Then last year we had the CARES Act, which was the stimulus act because of COVID. Most of this was a one-year only deal, and they've expired. For example, for last year, you didn't have to make your required minimum distribution. They were suspended for the whole year. As Blake will talk about, that provision's gone. The other thing we had last year, and I used it with a few clients, were COVID distributions. So if you were impacted by COVID, you had COVID, or you were laid off, or you were self-employed, you were able to take money out of your retirement plans without the 10% penalty, and you could spread the tax out over 3 years. And like I said, I had a couple clients who were in a cash crunch, and we took advantage of that. Again, those have pretty much expired. Then we just in the past few weeks had the Appropriations Act, which is kind of the Stimulus Act Part 2, where we had the additional round of the tax rebates, which technically they're not rebates, they're a tax credit against your 2020 tax return. And so that's the way it'll work. When we prepare your 2020 returns, we'll have to deal with the tax credit. And it was based on certain income levels from the prior year return. And if you weren't able to take, get the rebate checks because you had earned too much money in, say, 2019, then you may be able to still get that tax credit if your income was actually lower than expected. On the other hand, if your income was lower and you got the check, but it turns out you weren't technically entitled to it, they're not taking the money back. And then a couple other things in the Appropriations Act is they extended unemployment benefits, federal unemployment benefits for 11 weeks. And then they have a second round of loans for, the small businesses that are trying to take loans to stay afloat during COVID. So you can see we've got a pretty active, 3 or 4 year period. Some of this is because of COVID. Some of it was stuff that was already planned. And then, we'll see what happens on the legislative front for the next year or so, and we'll talk about that towards the end of the presentation. So we talked about the tax brackets, and what I showed you there was ordinary income. So that's your wages, that's interest, that's things like that. We also have different types of taxation that we need to take into account, and sometimes this allows us to take advantage of this and save on taxes. For example, capital gains. Capital gains rates are lower than ordinary income rates. So we typically want capital gains treatment. And you can see there's actually a 0% capital gains rate. So if we're lucky enough to have you fall into the 10 or 12% ordinary income tax bracket, the bottom two brackets, we can actually get you a 0 tax on your capital gains and your dividends. So there's a little bit of planning opportunity there. Again, it's limited, but at a minimum, we want to get you capital gains treatment instead of ordinary income treatment, because for most of you, that's probably 15% instead of 22 to 24%. And that goes for dividends from stocks as well. And so capital gains treatment is something that we're always looking to get if we possibly can. And that'll go into the strategies Blake's going to talk about: tax location planning, tax loss harvesting, et cetera. The other thing we have to take into account are state taxes. Some of you may not live in California, and you may be fortunate to live in a state that doesn't have a state income tax, which is fantastic. But California has the highest rates in the country. The maximum is 13.3%, and most of you are probably in between the 6 and the 10.3% tax bracket. California doesn't have a capital gains rate, so they're going to ding you with ordinary income. And then we have what's called the Obamacare, or net investment income tax, which is a 3.8% tax on your investments, your dividends, your interest, your capital gains, all of that kind of stuff. So if you're above certain income levels, 200 single and 250 married to filing jointly, you get the privilege of paying an extra 3.8% tax on your investment earnings. So, if we're looking at all of those together, maybe a marginal tax rate of 39.6 for the Fed, the California has a 13.3 top rate, and you throw in the Obamacare tax, theoretically you could have a 56.7% marginal tax rate. Now, that's an extreme example where people are in extremely high income levels, but that's kind of the max threshold at the moment is just shy of 57%. And then in addition to income taxes, there are estate and gift taxes. Now, the reality is that most of you don't have to deal with estate and gift taxes. We'll talk about towards the end of the presentation. But if you do, the tax is currently 40% on taxable gifts and taxable estates. It used to be as high as 60%. It's been reduced. This is one of the things that may change under the Biden tax plan, is that gift and estate tax thresholds may be lowered back to where they were, about a decade ago. So that kind of, frames the types of taxes we're looking at here. And so what are some of the mistakes that we see? And then we'll talk about some of the solutions we have to these mistakes. Probably the biggest one we see is we'll have a potential client come through the door and all of their tax eggs are in the pre-tax basket. So they've put everything they have into the 401k, into the IRA, whatever retirement plans they have. And, maybe it makes sense because, nobody wants to pay tax any sooner than they have to. The downside to that is you're going to pay tax sooner or later, and now you're going to pay tax on a much larger amount, and it's ordinary income. So putting all your tax eggs in the pre-tax basket doesn't make a lot of sense. We want to diversify just like we do with your investments. And then there are ways that people aren't really smart about their investment strategies, where we're investing, the portfolio is built so that it's very tax inefficient. And Blake's going to talk about tax location, tax loss harvesting, which are tax smart ways to invest. Again, we talked about capital gains rates being lower than ordinary income rates. So wherever possible, we want to create capital gain. We can't always do that, but we want to do that where we can. Blake's going to talk about why we don't use mutual funds in any of our portfolios because they're very tax inefficient. And then I'll kind of wrap everything up with talking about how you should organize your estate to maximize the inheritance for your heirs. So those are kind of the topics that we're going to put on the table for this evening. So let me start with, again, mistake number one, and usually the biggest mistake is you're not diversified in terms of tax treatment. We preach all the time being diversified from an investment standpoint. We want to do the exact same thing when it comes to taxes. So what we see is, I mentioned, all of the assets are accumulated in retirement plans, meaning that it's all going to come out as ordinary income. You're going to be forced to start taking it out at 72, and we have no flexibility. I mean, if you need to say you've got to pull $50,000 to repair the roof on your home, and all the money's in the IRA, for you to net 50, we're going to have to pull 80 because you're going to pay income tax on that distribution. And if we only pull 50, 30+% of that is going to go in taxes. So you're not going to net 50, meaning we've got to pull more. And so not having a bucket for emergencies and things like that can create real problems for you. And that's why, we really want to have some flexibility built into the plan that comes from tax diversification. So, what's the solution here? It's diversifying your tax buckets, just like we do in your investments. So there are really three basic tax buckets, and we want to have some money in all of these. So we have your taxable bucket, which is, your brokerage account, things like that, where we can maybe get some capital gains treatment. And maybe some of it will be ordinary income. Then you have your tax-deferred bucket, like your retirement plans. Then you have your tax-free bucket, probably the biggest example being the Roth IRA. The idea is if we can split your money up between these three buckets as much as we possibly can, now we've got some flexibility. And we can really do some really smart tax planning for you. So in terms of the tax-free bucket, the biggie is the Roth IRA, and we're going to talk about how we get money to a Roth IRA in a little bit. Another one that doesn't get used that much, but can be a really attractive vehicle is a health savings account. So if you're still working and you have an employer plan and it's what's called a high deductible plan, you can contribute to a health savings account, and this is the only vehicle that is what we call triple tax free. So you get a contribution, a tax deduction going in. So it's pre-tax. It grows tax deferred. And then if you pull it out to pay for health expenses, it's tax free. It's the only vehicle that provides a deduction going in, tax deferral, and tax-free. Now, there's limits on how much you can put in. There's limits at how long you can contribute. And like I said, you have to have a high deductible plan. But we want to look at whether there's an opportunity there for you to use one of these because it can be very tax efficient. Municipal bonds are an example of tax-free income, as are loans, home loans. And so, again, if you have a cash crunch, rather than pulling the money out of your IRA and having to take 80 to net 50, maybe we'd be better off doing a home equity line of credit or maybe a reverse mortgage because since they're loans, there is no taxation on those as long as they're repaid. So, that's the tax-free bucket. Everybody's familiar with the tax-deferred bucket. It's primarily the IRA and the 401k. Maybe if you have some non-qualified annuities, those also provide tax deferral. And then you have the taxable bucket that we talked about a little bit, where that's your basic investment accounts, it's your rental real estate, things like that. So let me kind of walk you through what I call the tax diversification grid and the pros and cons of each of these buckets. So we'll start with your basic 401k IRA. For most of you, the contributions going in are going to be pre-tax. Not everybody gets to deduct an IRA contribution, but the 401k contributions are going to be pre-tax. So the money going in is not taxed. While it's in the retirement plan, it grows tax deferred, meaning you can switch back and forth between investments without generating any tax. But the price to pay is when the money comes out, it's going to be taxable. The government didn't collect their tax up front, so they're going to collect it on the back end. And it's going to be treated in the vast majority of cases as ordinary income, meaning you're going to pay those 20, 22, 24, 37% tax brackets or whatever. And then at death, because they gave you tax benefits going in, they're going to collect the tax. So this is what's called income in respect of the decedent, meaning that if they didn't collect the tax from you, they're going to collect it from your beneficiary. Whoever receives that IRA distribution will pay the tax. So the tax does not go away. And then some of the trade-offs for that tax deferral and that tax deduction, you with limited exceptions, you can't take the money out prior to 59 and a half, and they force you to start taking the money out currently at age 72. So is it a good idea to have money in the pre-tax bucket? Absolutely. But we don't want to put all of our eggs in that basket. Then, as an example of the tax-free account, we have the Roth IRA. So, you can kind of look at that as the IRA in reverse. So you do not get a deduction going in. So you're using after-tax money for your contribution. Like the regular IRA, the money is tax deferred as it accumulates. You can make trades and there's no tax. The big difference is when you go to take the money out, because the government collected the tax on the front end, then you can get tax-free distributions. Caveat being, in order to get to tax-free distributions on the growth, you've had to have had the Roth for 5 years and you have to be over 59 and a half. But even if you're not meeting those two requirements, the first thing that comes out of a Roth IRA is your contributions or your what we call your cost basis. So let's say you put $50,000 into a Roth IRA and it's grown to $100,000, and now you need to put that roof on. If you pull $50,000 from the Roth IRA, the first thing coming out are your contributions, so those aren't taxed. And so we can pull that money out of that Roth IRA to put that roof on without taxes. Now, if we tapped into the growth, now you need to be over 5 years and 59 and a half. The other nice feature about Roth IRAs are there are no required minimum distributions. The government collected their tax up front, and so then they don't care about whether you take the money out down the road or not. And at death, when you pass away, your beneficiaries will also receive this tax-free. Now, they will have required minimum distributions, but who cares? It's tax-free. So they can cash it out in one shot, and it doesn't really matter. And then kind of the third bucket are just your personal investments, whether that's a brokerage account, whether it's CDs, a bank account, whether it's rental real estate, whatever it is. So whatever's going to those kind of accounts is again, after tax. We don't get a tax deduction. And then the tax treatment will vary depending on the type of asset. So again, kind of the holy grail is to get capital gains treatment. If we have stock or land or real estate and we sell it, we get that favorable capital gains treatment. We have some current taxation, like if stock pays a dividend, you're going to pay tax currently, but it's capital gains treatment. If you have interest from a bank account or a CD, you pay interest currently. And then appreciation on, say, stock or real estate, you don't pay tax on that until you actually sell it. So you have some tax deferral. So you've got a lot more flexibility with these after-tax accounts. So in terms of taking money out, it'll depend. If you've already paid tax, then you can pull that out tax-free. If it's appreciation on, say, a stock, you'll pay capital gains, but it's favorable rates. And then in terms of death, this one is totally different than the retirement plan. Again, because you probably have paid tax all along, then you get what's called a stepped-up cost basis. Meaning, if you have a stock or your home or whatever and you pass away, your kids or grandkids can inherit that. The basis for tax purposes gets stepped up to the date of death value, and now your kids can sell that without incurring the income tax. That doesn't apply to retirement plans, but for other assets, you get that stepped up cost basis. So kind of the trade-offs, again, you're not getting a deduction going in up front, but it's liquid. You can sell it at any time without any penalties. You don't have required minimum distributions. You have favorable capital gains rates. So again, one is not better than the other. Ideally, we want a mix of all three. And the trick is to come up with the right mix based on your situation, what you currently own, etc. Let me give you an example. We've got Bob and Joan here, and let's say they need $80,000 for their lifestyle. And they're getting $45,000 from Social Security. So we've got a $35,000 per year shortfall. For simplicity's sake, they have two accounts. They have $750,000 in a 401k. They have $250,000 in a Roth. So we've got that $1 million to pull that $35,000 per year shortfall from. So you can see if we take it first from the 401k, they've got their $45,000 of Social Security. They've got a $35,000 401k distribution, so they have total income of $80,000. However, that 401k distribution is taxable, and what they've done is they've probably made their Social Security benefit at least partially taxable as well. So in this example, Bob and Joan are going to have to pay about $7,400 in taxes. So we didn't accomplish the goal. They needed $80,000. The tax man got $7,300 of that, so they only netted $72,612. So not an ideal solution. So what's a better strategy? Well, hey, let's take it from the Roth. Now we've pulled that same $35,000 from the Roth, and we have the same total income. But guess what? The Roth IRA is income tax free. And the fact that the only other income they have is Social Security, they're going to fall below the threshold. So now their Social Security income is also tax free. So we didn't pay a penny in tax. So we netted them their $80,000. That's clearly a better solution. What's the problem with that? Well, we only have $250,000 of Roth IRA income. So at some point, we're going to run out, and we can't play this game forever. So is there another alternative? Yeah, using tax diversification and blending it. So in this case, what we're going to do is we're going to take that $35,000 shortfall from both the 401k and the Roth. So we still have the same income, $80,000, but now the Roth IRA is not taxable. Less of the Social Security benefit is taxable. And so the only thing that's 100% taxable is the 401k. And so now the tax is $1,350 instead of $7,388. So we got closer to our goal of $80,000. And the benefit of doing this, again, we're paying a little bit of tax as we go along. But if we're only taking $17,500 out of that Roth IRA, we maybe will sustain that for a much longer period of time, maybe even indefinitely. And so this is a great example of tax diversification. And if we had a non-qualified brokerage account on top of this, we even have more flexibility. And this is where we can get really creative. And I think this is where we kind of earn our fee from our clients, is coming up with the right strategy every year to optimize your tax situation. And this is something that will change year to year. And we pretty much have to run tax projections every year and figure out what's the best way to put the puzzle together for this particular year. And it gives us flexibility. So when those tax law changes happen, if rates go up, well, we can pull more from the Roth or the brokerage account. If rates go down, man, maybe it's a good time to take the money out of the 401k. So we have to take less out in the future. So tax diversification is very powerful. The trick is, how do we do that? How do we get to have all of those buckets? And so the ideal situation is, if we've got enough time, is we would have you contribute to these different tax buckets. So instead of maybe maxing out your 401k or making a maximum IRA contribution, maybe we split it between a regular and a Roth 401k. Or if you're eligible, rather than putting it all into a regular IRA, we put it into a Roth IRA. Like I said, if we have the opportunity to use health savings accounts, we want to take advantage of that as much as possible. And, in some situations, it may be as extreme as like, look, we don't want to put any more money into a retirement plan. You don't have enough liquidity. We need to just start putting some money into a regular old-fashioned brokerage or bank account so that you've got some liquidity for those emergencies. Again, everybody's situation is going to be a little bit different. We got to put the puzzle together a little bit differently. The other way we do it, and if you're not contributing anymore to these retirement plans, is to look at doing Roth Convergence, where we're going to convert some of your regular IRA to a Roth IRA. And so, how does this work? Is that we're going to take your regular IRA and we're going to say, you know what, we're going to convert that to a Roth, and we're going to be willing to bite the tax bullet this year and pay tax on the conversion. But the nice thing is, we'll never have to pay tax again after that 5-year and 59.5 rule. In addition, there are no required distributions. And as I mentioned before, your contributions in a Roth can be withdrawn first, tax-free. And so if we're doing conversions, that counts as a contribution from a tax standpoint. So now we've created some liquidity where we can pull money out tax-free. So the kind of the way I look at the Roth IRA is, with the regular IRA, you don't pay tax on the seed, but you're going to have to pay tax on the fruit. With a Roth IRA, you pay tax on the seed, but you don't have to pay tax on the fruit. One's not better than the other, but the idea is maybe to have both, so we can have some flexibility. Now, we're not going to tell you take your $500,000 Roth IRA and convert it to a Roth and immediately throw you into that 56% joint tax bracket. What we're typically going to do are what we call partial Roth conversions, where we're just going to convert little chunks of your regular IRA to a Roth over time and slowly build up that Roth IRA. So how would we normally do this? Let's say we've got John here who has income of $30,000. So John's in the 12% tax bracket. So we've got an opportunity here to pay some tax in a very low tax bracket. Well, the top of the 12% bracket for a single person like John is a little over $40,000. So usually what we would do is we say, okay, well, let's convert $10,000. So now John's going to have $40,000 of taxable income. He's still in the 12% bracket. So we'll pay tax of $1,200 on the conversion, but then John will never pay tax again. So if that $10,000 conversion grows to $50,000, no more tax and no RMDs. And so this is what we'll look at, and we'll run projections every year. Is like, okay, how do we keep you in the 12% bracket or the 22% bracket, or maybe even the 24% bracket? Above that, we probably don't want to look at doing it. But if we can do partial conversions and not throw you into the next highest tax bracket, that's kind of the process. So there may be some years where we do a conversion, there may be some years where we don't do a conversion, but we can slowly over time at least build up some money in the Roth and give us a little bit more flexibility. So that's how a partial Roth conversion works. It's something, when we're doing your financial planning, we're going to look at every year on a year-by-year basis, do some tax projections, figure out if it makes sense, and if it does, how much can we do, and then ideally just slowly over time do some tax diversification. Okay, so that brings us to our first poll. And then I'm going to turn it over to Blake to continue the presentation. So let me pull the poll up, and you guys can just answer this quickly. So Blake, I'll go ahead and turn it over to you. You guys go ahead and answer the poll. Oh, let me launch it. There we go. Now you can see the poll. And so you can go ahead and answer the poll, and then I'll turn it over to Blake, and he can talk about some more tax strategies.
Perfect. Thank you, Jim. So the poll question we're asking here is, do you owe each year or do you receive refund? So when you're filing your taxes or someone's filing on your behalf, do you find yourself paying the IRS or receive a refund? And believe it or not, there's opportunities embedded on both sides of the coin. If you find yourself receiving a large refund, maybe it makes sense to look at those Roth IRA conversion opportunities that Jim discussed. On the other side, if you're owing money to the IRS, maybe there's opportunities that we could help save you money on taxes. So going to the next slide here. Oh, looks like we got some poll results. Owe a small amount. Okay, so it looks like the majority of us owe a small amount. So it could only be one minor thing that could help save you money on taxes. So it's definitely something that we'd like to look at. Next slide here. So 3 mistakes related to tax and investment planning. Jim mentioned it earlier, is not using tax location planning. So not using the right investments for the right accounts, i.e. if you used a municipal bond in an IRA, that would not be the right type of investment for that specific account. The second mistake is using tax inefficient investments. So a mutual fund in a type of taxable account, like a trust or an individual account. And then the third mistake would be not using tax loss harvesting techniques in your taxable individual brokerage accounts. Next slide, please. So the solution to this first tax location mistake would be to incorporate tax inefficient investments in your tax deferred buckets. So what does that mean? Utilize bonds or high turnover funds, so mutual funds, in your IRA, your 403B, your 457, those types of qualified tax deferred accounts. Bonds have interest income that they generate, which is taxable as ordinary income, and mutual funds have capital gain distributions. Both of these two do not leave you in a good tax situation. The other side of that would be put tax efficient investments in your taxable accounts. So that's saying stocks and stock ETFs and those taxable accounts, because they can qualify you for capital gain treatment, which Jim mentioned earlier, which have lower tax rates as compared to the ordinary income treatment of those tax deferred accounts. Or the dividends could be qualified if they meet a certain criteria, meaning they could have that same tax rate as a long-term capital gain, so a 0%, a 15%, 20%, so on. And then the last would be using tax loss harvesting techniques in those stock or individual brokerage accounts. So an example of this, I mentioned it earlier, but in your IRA, holding bonds. So bonds are going to generate that ordinary interest income, and we want that to grow tax deferred for as long as possible, because it's the tax treatment that's the least benefit to you. So as long as we can delay that in that IRA, we'd like to do that. In addition to that, the IRA, you're going to have to take those required minimum distributions once you reach the age of 72. So if we can grow that account more slowly with bonds, leads to lower eventual required minimum distributions. With your taxable accounts, as I mentioned, we want to hold stocks and stock ETFs. If you hold stocks for longer than 1 year in a taxable account, they qualify for that long-term capital gain preferential rate. So that's the 0% to 15% to 20%. If you hold it for less than a year, then it would be the short-term ordinary income rate. So what we like to do here at Anchor Bay is hold your stocks in your taxable accounts for longer than 1 year before we sell, because we want to make sure we qualify for the preferential lower tax treatment. And then, as I mentioned as well, we can use tax loss harvesting to offset gains, and I'll go into that shortly here.
Yeah, so just an additional comment here, Blake, is, if we're managing multiple accounts for you, say we're managing your individual or trust account, we're managing your IRA, your SEP, we're going to have different assets in each of these buckets. So we're looking at your portfolio as a whole, but you're going to see varying rates of return for each of these accounts because we're not investing them all the same. We're using this tax location strategy, and so it may be that your IRA is performing at a lower return level than your taxable account. That's deliberate. And so, just know that we're looking at your portfolio as a whole, but if we're using tax location, each type of account you have may have different investment assets in it.
Yep. Thank you for that, Jim. So going to the idea of tax loss harvesting here, essentially what that means, breaking it down, it's selling your investments when they have losses to offset them with future capital gains. Best way to understand this is through an example. Think back to March 2020 and the height period of COVID. The market was down 20 to 30%. You may have seen some capital losses within your investment portfolio. Our investment committee utilized this time to capture those capital losses with the idea that they can offset them on future capital gains. So say in March, they captured 10,000 of capital losses. In December of that same year, they could use that capital losses to offset, a future capital gain of 10,000, and the end result would be a wash. You would have no capital gain taxes because you use that 10,000 loss from March to offset it with the 10,000 gain in December. And what's great about capital losses as well, if you have capital losses that carry over into another year, you can use 3,000 of those capital losses against your ordinary income on your tax return. So it's an above the line AGI deduction that you can write off, and it will actually lower your taxes. As well with capital losses, they carry over indefinitely. So if we captured 20,000 capital losses in March, we used 10,000 to offset capital gains. We use 3,000 for your taxes. We have 7,000 being carried forward into 2021 that we could use to offset 2021 capital gains, etc. So that's tax loss harvesting in a nutshell. Next slide, please. Okay, so Jim alluded to this earlier, but mutual funds have some horrible tax consequences at times. And the reason that is mutual funds accompany a mutual fund manager, which does not consider your individual tax situation when they're making decisions related to the mutual fund, or rather sales within the mutual fund. So think of a mutual fund as a pool of multiple different investments embedded in one single wrapper. The fund manager is going to sell investments in the mutual fund and recognize gains. Those gains are passed directly along to the individual consumer, individual investor in the mutual fund, which we refer to as capital gain distributions. So if you have a mutual fund in a taxable individual brokerage account, such as a trust, you might receive a 1099 showing a large capital gain distribution that could propel you into a higher tax bracket. Say you're close to Social Security age, or you're already claiming Social Security, and you're on the cusp of your Social Security benefits being taxable, or you're getting close to your Medicare premiums increasing at a higher limit. Those capital gain distributions could eventually get you in a worse situation and create more turmoil for from a tax standpoint. So we really try to incorporate ETFs and stocks in your taxable accounts and avoid mutual funds at all costs, because we don't want to harmfully impact you with those capital gain distributions. All right, next slide, please. All right, so from here, I'll turn it over to Jim to talk about tax and estate planning.
Okay, so another area we want to look at is how do we pass your assets along to your heirs and to charity more efficiently? And so there are opportunities to save money on taxes at death, just like there is, with living tax planning, like we just talked about. And so, some of the things we look at, as I talked in when I went through that tax diversification grid, is how some assets get a stepped up cost basis. Probably the biggies are real estate and stocks. So, if you die with stocks and real estate in a taxable account, the value from a tax standpoint gets stepped up to the value on the date of death, and then your heirs can sell it without capital gains treatment. Now, let's say, for example, you own your home and it's worth $1 million, and you paid $100,000 for it. So if you sold the house, you'd have capital gains. If you hang on to it and you pass away, the value from a tax standpoint now gets stepped up to $1 million. Your heir can sell it for $1 million and walk away without any tax. Now, if they inherit it at $1 million and it grows to $1.2 million, when they sell it, they'll pay capital gains tax of $200,000. But that stepped up cost basis is pretty important. And we're looking at this when we're our investment team's managing your portfolio. It's like, if you're up there in age and you've got a bunch of built-in gain, we may want to just hang on to that stock, even if we don't really want to from a risk standpoint, simply because we could potentially avoid that big capital gains tax. Now, on the other hand, those retirement plans that we talked about in the tax allocation grid are subject to what we call income in respect of a decedent or IRD. You didn't pay the income tax, so the beneficiary is going to pay the income tax. And we used to be able to stretch that out over their life expectancy. Now they're forced to take it out over no more than 10 years, so that's going to accelerate the tax. So we've got to look at the tax treatment of these assets at death. Now, there is still an estate tax. And as I mentioned, right now, the bracket for the estate tax is 40%. It's been as high as 60%. But what makes the estate tax really a non-issue at this point is each individual has an $11,700,000 exemption. So if you're a single person, as long as your estate's below $1,700,000, you don't have to worry about the estate tax. If you're a married couple, right now you're at $23,400,000. And so 99.9% of the population does not need to worry about the estate tax anymore. I spent 20 years of my career pretty much specializing in helping athletes and entertainers and corporate executives, et cetera, try and use strategies to minimize the estate tax. We don't even discuss it anymore. Now, the one situation you should be aware of is, now California does not have a state inheritance tax. But there are states that do. For example, Washington State has a $2 million inheritance tax threshold. New York has a $2 million or $2.5 million threshold. So while you may not be subject to federal estate tax, you could potentially be subject to state estate tax. And we need to look at that and figure out the numbers. What you need to know about the estate tax is these high exemptions are scheduled to sunset at the end of 2025, and they'll revert back to what they were before, which was still a pretty nice $5.5 million per person exemption. So we're still talking $11 million. But at the moment, the estate tax and gift tax is nothing to worry about. But we'll have to see what happens in the future. So really, what it boils down to at death is income tax planning. My first comment here is not all assets are equal at death. So, let's say you've got 2 kids you want to pass your estate to, and you have 2 assets. You have your house and you have your IRA. Well, not all these assets aren't equal. Let's say they're both that $1 million value, and you give kid A your IRA and you give kid B your house, thinking, this is fair. They both got $1 million. Well, the IRA is going to be subject to that IRD tax. So kid A is not going to inherit $1 million; they're going to inherit $700,000. So we have to incorporate that in the income tax planning into your estate plan, so that if you want to have a fair and equitable distribution, we've got to look at the tax treatment of the assets you want to pass along, and design a plan so that it's fair and balanced. At the same time, if you plan on giving something to charity at death, making some kind of charitable bequest, the strategy here is we want to pass the good assets to your heirs, those stepped up cost basis assets, and pass the bad assets, those IRD assets, to charity. And let me give you an example here. So let's say John has 2 assets, got an IRA worth $100,000 and a stock portfolio worth $100,000. And this is pretty much just like the example we talked about with child A and child B. So if the plan is I'm going to leave half of it to charity and half to children, normally what we would see would the children would be named the beneficiary of the IRA, and then the stock would pass to charity through the will. And what happens in that result? Kids inherit that IRD asset. They inherit that IRA. So if we assume a 30% combined tax bracket, they're only going to net 70. Uncle Sam inherits $30,000 of that IRA. Now the charity inherits $100,000 because charities are tax-free. They're tax-exempt entities. So they net $100,000. And either way, they would have gotten a stepped-up cost basis even if they weren't tax-exempt. So that didn't work out too well. In this case, the inheritance was split three ways between the kids, charity, and Uncle Sam. Now, if we make one simple change, nothing fancy here, if we name the kids as the beneficiaries of the stock in the will, and we name charity the beneficiary of the IRA, what have we done? Now the kids inherit that stock. They get that stepped up cost basis. So they net all $100,000. Charity inherits the IRA. Yeah, the income respective of decedents do, but guess what? Charity is a tax exempt entity, so they don't pay it. So now we essentially cut Uncle Sam out of that equation, and we didn't do anything other than make sure that we had the distribution scenario set up so that the good assets pass to the kids and the bad assets pass to charity. Very simple fix, and it's a common mistake we see. So again, when we're doing your estate planning, we want to look at those kind of things and have a discussion about what your charitable intentions are. Another strategy that we can use, and again, we're not worried about like minimizing estate taxes or anything by making gifts. This is a income tax strategy. It's what we call upstream gifting, and I've used this a couple of times, and it works out really well. So normally what you think about when doing gifts is, hey, I'm going to make gifts to my kids or my grandkids and, help them buy a house or to save for college or whatever. And each person has a $15,000 per person annual exclusion that they can use before they even tap into their $11,700,000 exemption. So the idea here is instead of giving that gift downstream to your lower generations like kids and grandkids, we're going to give it upstream to your parents or your grandparents. And then what will happen is when that older generation passes away, then you can re-inherit those assets and receive that stepped up cost basis. And let me give you an example here. It's a real life example that was actually even more significant than what I've shown here. So I had a client, Joe, who owned a large share of Apple stock. In this example, we assumed he had 1,000 shares of Apple. He bought it at $25 a share. So he paid $25,000 for that stock. It's now at $150 a share. I think today Apple closed around 143 or something. So it's in the ballpark. So if Joe sells that Apple stock, he's going to have a capital gains tax on $125,000. He'd probably also likely have the 3.8% Obamacare tax. Joe had a mother who was in her 90s. She was in good health, but she was in her 90s. So, life expectancy wasn't going to be that long. So what we did is we set up a brokerage transfer on death account for Joe's mom. We gifted those shares of stock to Joe's mom. We filed a gift tax return so that we reported it and we started the window ticking. And kind of the one catch here for this to work is that older generation that you give these assets to, they have to live at least 1 year. They have to live 12 months from the date of the gift in order to get that stepped up cost basis. In this example, Joe's mom passed away about 1.5 years after we made the gift. Joe's mom got the Apple dividends while she was alive, so she benefited from it. But then when she passed away, Joe re-inherited the money through the transfer on death designation, but the basis was stepped up to the date of death. So Joe now get that stock back with $150,000 cost basis. We were able to sell it and eliminate the capital gains tax. And so, we probably saved Joe in the neighborhood of $20,000 in tax by using this upstream gift strategy. Is it going to work for everybody? No. But again, it's not what you make, it's what you keep. And so we're always looking for where can we use strategies like this to save you on future taxes. And so kind of my last topic before I turn back over to Blake is in the area of charitable planning. If you are charitably inclined and maybe you're already making gifts, there are things we can do in terms of more than just your normal charitable deduction on your itemized return. Things like gifting appreciated property. Let's say you have a stock or you have a mutual fund that does have a bunch of gain built into it, and you're going to make a $10,000 gift to charity anyway. Well, we're better off giving that $10,000 mutual fund away, because if you sold it, you're going to incur the capital gains. And if you transfer to charity, again, charity's tax exempt, they can sell it and the capital gains just goes away. So if we've got a choice between gifting cash and gifting some kind of appreciated property, we're better off giving the appreciated property. It's going to save you, again, $1,500 or so in tax. You'll still get the tax deduction, but you bypass that capital gains tax. If we really want to move the needle and get large deductions, we may make a bunch of gifts in 1 year to what we call a donor advised fund, where you put it into a donor advised fund, and Fidelity has one, as do other organizations, where you can kind of control the distribution of those funds to various charities and make grants. So if you're making gifts to a bunch of different charities, it might make sense to set up a donor advised fund and then just make grants of that money every year. But we can, pre-fund it with one large contribution. And, maybe you have, you sold a piece of real estate, or you sold your company or something like that, and you've got a big tax hit in 1 year. You using a donor advised fund, make a large charitable gift offset that tax might make sense. We can also get really sophisticated and do things like charitable remainder trusts and charitable lead trusts, where we can provide a lot of tax benefits. And then there's something that doesn't get talked about hardly at all, but I think could be a really appropriate charitable gift, is something called a charitable life estate. The idea with this is that you could actually give your home to charity today, but then live in it for the rest of your life. And so the fact that you gave it to charity today creates a tax deduction for you. Now, if it's a $500,000 house, it's not going to be a $500,000 deduction because you've retained the right to live in it. But it may be a $250,000 or $300,000 deduction. So if you're going to make a substantial gift to charity when you died anyway, maybe we look at giving your house away today, and you get to keep living in it, and we can generate that large tax deduction and maybe use that to do a big Roth conversion or to offset the sale of something else. Again, we evaluate all these based on your individual circumstances. And then the last one is what's called the Charitable IRA. So once you hit 70 and a half, you have the opportunity to use this. Now, this used to be tied to the 70 and a half required minimum distribution date. That's now 72. But at 70 and a half, you can start transferring up to $100,000 from your IRA to a public charity, and it's a tax neutral transaction. You don't get a deduction, but you also don't pay the income tax on that $100,000, which you normally would. And it counts as that required minimum distribution. So if we're going to have to make a required minimum distribution that you're essentially just going to pay the tax and stick back in your bank account, and you're already making cash gifts, we'll make a transfer of that amount from your IRA directly to that charity, and we can, again, bypass the tax and count that as your required minimum distribution. So if you are charitably inclined and you want to do philanthropy, we've got a lot of expertise in this area, and we can help you come up with some strategies. And again, this is probably the one area where we really can move the needle in terms of getting tax deductions is charitable giving. There aren't a lot of other options available to you. So a couple last comments for me in terms of what's going to happen in the future. I previously mentioned that the TCJA, the Trump Tax Act, is scheduled to sunset on December 31st of 2025. So if we don't have any other tax legislation between now and then, that will sunset and we'll revert back to the old rules. What that means is the corporate rates would go up, some of your itemized deductions would come back. The standard deduction would go down. The estate tax would go back to a $5.5 million exemption, things like that. Probably isn't going to happen. I mean, I would venture to guess that there'll be some kind of legislation between now and then. But, that will be the next one absent anything else. Now, we do have a change in president, and we also have a change in Congress, where Congress is now pretty much split between the Democrats and Republicans. Democrats have marginal control because Vice President Harris will have the deciding vote. So it could be feasible that we will see some kind of tax legislation. It would have to be bipartisan to get it done. So I don't think we're going to see anything radical one way or the other. I think, it could be kind of middle of the road. And what President Biden has proposed, I think for the vast majority of our clients, I don't think is a big deal. I think it'll be okay. So he has proposed no tax hikes for anyone making under $400,000. That's kind of his threshold. And what he's proposed is going back to the 39.6 from the 37. He's also proposed eliminating the Social Security cap. So right now, if you're working, they stop taking out your Social Security, tax at roughly $140,000 or something like that, and then you don't have to pay that tax. Now the Medicare is not capped. And so what he's proposed is going back to something like that where, maybe it would remain uncapped like Medicare, or I believe he's capped it and then it would come back at something like the $400,000 income level where you start paying Social Security tax again. He's also proposed putting a cap where your itemized deductions can't benefit more than a 28% tax bracket. So none of those are super radical, and they're not going to move the needle greatly for people. Now, he has proposed increasing the corporate tax back to close to what it was. So that one definitely would impact corporations and businesses. He has also proposed lowering the estate tax exemption back to $3.5 million per person. And now, if you're a single person, it's indexed for inflation, so it would probably be more in the range of $4 million. If you're above $4 million, we potentially have to start worrying about estate taxes again. If you're a married couple, you'd be looking at, the $8 million range. So it may affect more people. Again, it's a pretty high exemption, so the vast majority of people still wouldn't have to worry about the estate tax. He's talked about some other things like increasing the child tax credit and having a first-time homebuyer tax credit, et cetera. And then one that I think is particularly important for people who live in Southern California is he would eliminate that $10,000 cap on state and local taxes. So you're paying more than $10,000 in property tax and state income tax, you'd be able to deduct the whole thing again. So I don't think there's anything super onerous in here. Whether it gets passed, who knows? Again, it's going to require buy-off on a kind of a split Congress. And, he's got bigger fish to fry at the moment with COVID and everything else. So I don't anticipate any major tax changes this particular tax year. So that leads us to our next poll, and then I'll turn it back over to Blake to essentially bring us home.
All right, perfect. So Jim will pull up that poll.
There we go.
There. So the question we're assessing here is, how do you file taxes each year? Oh, Jim, that's poll number 1.
Oh, okay. Well, let's see. Let me in that one. There we go. There we go.
There we go. Okay, so how do you file taxes each year? Do you pay an accountant / CPA or other preparer? Do you do it yourself through TurboTax or other provider? Anchor Bay does it on your behalf, or do you get some assistance from a family, friend, or colleague? So as Jim mentioned before, we do prepare a lot of tax returns. He's an enrolled agent now. I just registered to become a tax preparer, so I'll be assisting him for this 2020 tax season. So we get the poll responses?
Yeah, let's see.
Okay, so it's fairly split. Looks like most of you have us do it on your behalf, and then a few of us pay an accountant CPA. All right, perfect. Thank you for that. So just some strategies, I'll be brief here, to keep in mind for 2021. The medical expense deduction has been lowered back down to 7.5% of your adjusted gross income. So the best way to understand this is through an example. Say your adjusted gross income was $100,000. Your medical expenses above $7,500 for the year of 2021 would be included in your itemized deduction calculation. So all of those amounts above 7.5% of your adjusted gross income. Another relatively new provision is being able to use money from a 529 plan for student loans. So if there's a 529 plan for the benefit of, say, your kid or a grandkid, you're permitted to use $10,000 of those funds to pay off their student loans as a one-time a benefit to you. So that's a new addition that's pretty interesting to most, because student loan debt is fairly robust at this point. Keeping the same charitable vein here, new in 2020 and extending into 2021 was being able to donate $300 of cash to a charity that's a nonprofit recognized 501c3 organization. So in 2021 as well, if you're single, you're able to donate $300 to a charity and deduct that above the AGI, or essentially write that off, lower your taxes. What's great about that is you don't have to be itemizing to reap that benefit. So you can get that $300 above the line deduction if you're single, and take the standard deduction. And if you're married, filing jointly, it doubles to $600 for year 2021. So it's a great benefit to take advantage of, again, if you have that charitable mindset. As well, for charitable sake, you're able to contribute 100% of your adjusted gross income as a cash contribution. So similar to my previous example, say your adjusted gross income for year 2021 was $100,000. You could contribute $100,000 to charities and then have that significantly lower your tax situation, which may or may not be a benefit. So that's something you'd want to analyze. We talked about it a little bit. RMDs are back. So really, we want to be mindful that these are required if you're over that age of 71, so you're 72, and you will face significant penalties if you do not take that. So we'll make sure that we incorporate this into our financial planning reviews this year. Moving forward, some smart tax planning. Recap here based on everything that we've talked about today. Idea of tax diversification, so spreading out into those different tax buckets, utilizing Roth Convergence, incorporating tax location planning, using the right types of investments for the right type of accounts, utilizing tax loss harvesting within your taxable individual brokerage accounts. Remember, we're offsetting gains with capital losses, capturing those capital losses, bunching your itemized deductions. So I think we talked a little bit about this, but essentially what it means is if you're giving to charity $5,000 year after year, maybe it makes sense to give $10,000 in 1 year and have that be your charitable contribution for the next year. So it's just bunching those contributions into 1 year where you think you'd be able to claim the itemized deduction over the standard deduction. As well, it's similar to medical expense deductions. If you feel like there's a surgery on the horizon that you've been looking to do, maybe it makes sense to do in a year where you're giving a lot to charity, so you exceed that standard deduction and get the greatest tax benefit. Jim talked about the charitable strategies, charitable IRA transfers, charitable remainder trusts, charitable lead trusts. All these are ways to give to charities, but also reap a tax benefit, especially for your heirs. Overall, just be smart about estate planning. We want to make sure that those IRAs are left to charity if you do want to leave them to charity, or leave that individual account, that brokerage account, that joint account to your heirs, because that's going to get that stepped up in cost basis, which is going to be the greatest benefit for those inheriting. So how Anchor Bay can help you all. Tax planning is our specialty. Jim's an enrolled agent. I'm an aspiring enrolled agent. We both can prepare tax returns, but we both also have a passion for tax planning. So we really enjoy looking at these different scenarios and finding the one that best optimizes your individual situation, helps lower your taxes as a whole. As Jim mentioned, it's like a puzzle, just putting the pieces in the right spot. We fully incorporate this into your financial planning and investment management. So we're looking at these ways all the time, in not only the financial planning lens, but also look at this as well when they're managing your portfolio on a daily basis. We can prepare your tax return if we do not already. I saw from the poll a few of you pay an accountant, so that's a service that we do provide for our clients. You'll see our contact information in the next slide, but we'll also include it in the follow-up email. Because Jim's an enrolled agent, he can represent you in front of the IRS, and we're always going to act as a fiduciary, acting in your best interest 100% of the time.